On today's episode, we will be discussing the differences between ETFs and mutual funds. By the end of this video, you will hopefully be able to determine which option is the right path for you. Let's find out. Charlie, what happened? If you're new here, this is Sika Savvy. Over here, we talk about all things finance related. As always, this is not financial advice. Please do your own research to make an informed decision. Medase. Alright, let's start with the basics. First of all, what exactly are ETFs and mutual funds? We're going to break it down step by step. Yɛkasa ETF a type of investment fund. I time from exchange traded funds. I trade on the stock exchange, which is similar to how you trade individual stocks on the stock market. ETFs, they can hold a variety of assets, be to say stocks, commodities, be to say gold and oil, and asset bonds. Because say ETFs are traded on stock exchanges, you can buy and sell them throughout the trading day, just like you would with individual stocks. Your free net asset value. The total value of the ETF's assets, which is the stocks, bonds, and etc., divided by the number of ETF shares, and your friend said net asset value. Net asset value, representing what each share of the ETF is worth based on the underlying assets. Your science of arbitrage mechanism. ETFs, they use an arbitrage mechanism to ensure their market price always stays close to the net asset value. Here's how it works. For example, if the ETF's market price is higher than the net asset value, traders can buy the underlying assets and create new ETFs and then sell them at a higher market price. This increases supply and brings down the market price. Now, if the ETF's market price is lower than its net asset value, traders can buy ETF shares, redeem them for the underlying assets, and then sell those assets for a higher price. This decreases supply and brings the market price up. Now, our process way, it helps keep the ETF's trading price aligned with the value of its underlying assets. To break it down further, ETF, an asset exchange traded fund, acquires a pre-packaged fruit basket. For example, Walmart, a collection of different fruits in their stocks and other assets that you purchase as a single unit. Now, just like a fruit basket, you can buy and sell an ETF at any time the market is open. And its price changes throughout the day based on the value of the fruits inside of the basket. Now, let's talk about mutual funds. Mutual funds investment vehicles are a pool sika from many investors to purchase securities. Managed by a professional portfolio manager who allocates the fund's investments and attempts to produce capital gains and asset income for the fund's investors. Now, using the same fruit basket analogy, mutual funds acquire a custom-made fruit basket or order in advance. Basically, how this works is you give your money to the market organizer, which in this case is the fund manager, who will then go around to different aisles to buy the fruits for your basket at the end of the day. Now, the price of your custom fruit basket is determined once a day after all the buying is done. So you can't sell it immediately if you want to. You just have to wait until the end of the day. And now that we've got the definitions out of the way, you're diving into the key differences between ETFs and mutual funds. Now, one thing to consider are trading windows. One of the main differences between ETFs and mutual funds is how they are traded. ETFs are traded on the exchange throughout the day, which means you can buy and sell them just like stocks. Mutual funds, on the other hand, are traded only once per day after the market closes. This means ETFs can offer more flexibility for active traders who want to react to the market changes in real time. Mutual funds, on the other hand, are more suited for long-term investors who are not as concerned with daily price movements. Another thing to consider are fees. Generally, ETFs tend to have lower expense ratios compared to mutual funds. What is an expense ratio? An expense ratio is the measure of the annual cost of owning an investment fund, such as an ETF and as a mutual fund, relative to the assets and the management. It is expressed as a percentage of the fund's total assets and includes various fees like management fees, administrative fees, and any other operational costs. For example, if a mutual fund has an expense ratio of 1%, it means for every $1,000 you invest into the fund, $10 per year will go towards covering these costs. Now, the remaining $990 is what is actually invested in the underlying assets. Lower expense ratios no are generally preferred because they reduce the overall cost to the investor and they can lead to higher net returns over time. Now, the reason why most ETFs have a lower expense ratio no because most ETFs no are passively managed, meaning they track a specific index rather than trying to outperform it. Mutual funds, on the other hand, no, have higher fees due to the active management by a portfolio manager na account wasem no. One thing to note is fees no is not the only cost to consider. ETFs no might also have brokerage commissions. And while these have come down significantly in recent years, no, they can still add up, especially for frequent traders. Another thing to consider is tax efficiency. ETFs are generally more tax efficient compared to mutual funds. Because of how they are structured, allowing investors to manage capital gains more effectively. Mutual funds, on the other hand, no, might distribute the capital gains to investors, which could result in a tax liability. I know, at the end of capital gains, you may ask. Say, capital gains are. Capital gains are referred to the profit you make from selling an asset at a higher price than you originally paid for it. This can apply to investments, be to stocks, bonds, real estate, any other property. For example, you buy a stock for $100 and you later sell it for $150. Your capital gain here is $50. Now, there are two types of capital gains. You have short-term capital gain and you have long-term capital gain. Short-term capital gain is basically the profits from assets you've held for 1 year or less. This is typically taxed at a higher rate. And a long-term capital gain are the profits from the assets you've held more than 1 year, usually taxed at a lower rate. Until typically it's beneficial to you, the investor, to sell your assets after you've held it for more than 1 year. How do you decide which one is right for you, ETFs or mutual funds? So when you're a long-term investor and you prefer a hands-off approach, mutual funds might be a better choice for you. Like I said before, mutual funds offer professional management. And if your investment strategy is to set it and forget it, and you are good. However, if you prefer more control over your investments and like the ability to trade throughout the day, then you would any ETFs. One good thing is both ETFs and mutual funds offer diversification, which is crucial for reducing risk inside of your portfolio. It is also possible to have a mix of both, taking advantage of the strengths of each one. The crack the best choice depends on your personal investment goals, your risk tolerance, and your investment strategy. It is always a good idea to do a thorough research and maybe even consult a financial advisor to determine what's best for you based on your situation. I hope this video helped clarify the basics of ETFs and mutual funds for you. If you found this information useful, make sure to hit the like button and subscribe to the channel. Me dase, say ene, o join me. That's ene, ye bishia.